Hello traders, you're welcome to today's video. In this video, we are going to be looking at a trend line strategy that can give you insights on how to spot reversals and continuations, okay? And we're also going to be looking at how to combine trend lines with other indicators. All right. Now, basically, identifying and drawing trend lines accurately is essential for effective forex trading. Okay, so just because of that, we have to look at a step-by-step guide on how to use trend lines accurately. So first of all, you have to select your time frame, the time frame that you want to trade on. It's very important. So maybe if you are a scalper, you can look for smaller time frames. For a day trader, you can consider maybe 30 minutes, 1 hour. A swing trader might go into 4 hours daily time frame. Okay. Now you have to note that the higher the time frame, the more stronger the signals. So when using trend lines, you have to identify swing highs and lows. Swing highs are peaks in the price action when the market turns downwards. On the other hand, swing lows are valleys in the price action. These are peaks, these are swing highs, okay? Swing highs. While swing lows are valleys in the price action where the market turns upwards, okay? Now to draw a trend line, look for at least two swing highs or lows. Two swing highs or two swing lows. Then use that to plot your trend line. So I use this and this to plot my trend line. And then let us look for another example. You can see it's very easy. Let's do for swing highs. You can see that. Look for another example. You can see that. Alright, so basically just look for two swing highs or two swing lows and use that to draw your trend line. Now, an uptrend line is a trend line that connects two or more swing lows. For example, this is an uptrend line. So it's important that you extend the line into the future because the more times the price touches the line without breaking it, the stronger the trend line, and it can help you to observe to identify potential reversal zones in the future. For example, this trend line that was drawn from this point all the way here, it was still valid. You can see that it was still causing price rejections here. This same trend line, there was rejection here, there was rejection here, there was almost rejection because price almost got there. So it's important to draw your trend line into the future. So long as price still moves within that zone where the trend line is, then it still remains valid. Okay. Alright. As the market evolves, you can now adjust your trend lines accordingly. You can also draw more trend lines when price begins to go away from the direction of your trend lines. Okay. All right. Now, how do you use the trend lines to spot reversals? Basically, a break of a trend line can indicate the break of a trend line can indicate the potential reversal in market direction. For example, if the price of of an asset breaks a trend line downwards, let's look for a good opportunity for that. Good example. Okay, here we had a breakage. You see that price broke below this trend line downwards. The signals that the downtrend is about to happen. I can see that price sold all the way to this point. On the other hand, when price breaks a downtrend line and goes up, you can see it broke above it and went up. You can see it signaled a potential bullish reversal and see price went all the way up. Okay, now in terms of continuation, trend lines act as dynamic support and resistance zones. So when you have price bouncing off the trend lines, it can signal potential continuation in the direction of the trend. This for a bearish trend, for example, and this for a bullish trend. Now you can also combine trend lines with other indicators like the moving averages. You can add the moving averages, select the period that you want, you know, just for additional confirmation. So when you have price trading above the moving averages, it signals buy trend. When price is trading below the moving averages, it signals sell trend. You can also add on the RSI. The RSI can give you insight into overbought and oversold conditions. So if the price, for example, is near a trend line, and the RSI indicates overbought condition. Like in this situation, it was a perfect example, right? It signals a reversal because you can see that as RSI began to go up, price was also going up, bouncing off from the trend line. Now, in terms of Fibonacci, it's another important indicator that you can use. Okay, Fibonacci retracement is another important indicator. Okay, all right, for example, Fibonacci retracement levels can help show you potential reversal points as well. After you've identified the trend, for example, this is a bullish trend. Okay, the Fibonacci retracement levels can help you find potential reversal areas such as this 61.8%, 50%, 38.2%, 23.6%. Those are potential reversal zones, and we can see that price respected this zone. For example, you can see price bounced off this 50% level. Okay, now candlestick patterns is another important indicator to use. Like this one is price action though. You can look for candlestick patterns at trend lines for additional confirmation. So when you find bullish candlestick pattern around the trend line, can signal a bullish move. When you find a bearish candlestick pattern around the trend line, can signal a bearish move. Okay, now it's very important that you identify the trend using the trend lines and ensure it's confirmed with other indicators. So once you identify the trend, you can use other indicators to just confirm your entries, confirm your exits, and all of that. Indicators like the RSI, the moving average, any other indicator of your choice as well. And then you plan your entry near a trend line with a candlestick pattern confirmation. Okay. And then, as for risk management, set your stop loss orders just below the trend line if it is for a buy trade, and above the trend line if it is for a sell trade, okay, to manage your risk. If the price closes beyond the trend line, it may signal that the trend is invalidated. So in a sell trade, you can just consider using a tight stop loss that is just above the trend line, above that swing high. It's for a sell, just above the level that price was rejected. It's for a buy, just below the level that price was rejected, okay? And then for your exit strategy, you can consider exiting trades as the price approaches significant resistance and support levels, or when the trend line breaks. So you can either wait for a break of the trend line. For example, in this situation, as the trend line broke, we would have exited our buy trade, or we could have considered using horizontal support and resistance levels to also determine our exit points. Those are also valid exit points. Okay, so basically, trend lines are powerful tools for forex traders, and they help you to visualize market direction and potential reversals. By combining trend lines with other indicators, you can enhance your trading strategy. You can make informed decisions to improve your trading outcomes. However, remember to practice drawing trend lines and analyzing price action regularly to hone your skills. Okay, so I hope you found this video insightful. Kindly like and subscribe for more trading insights. And don't forget to hit the notification bell so that you don't miss out on more trading updates. Cheers and happy trading.